Blood, blood, blood everywhere. The last couple of weeks have been overall blood red across the stock markets. With that said, many stocks have in turn suffered severe blows since spring-summer this year. In this episode, we'll go through the possibility of the markets having in fact topped out for this cycle. In such case, it was a good 12-year run, but every party ultimately comes to an end when the music stops. We will provide this thesis with a series of timely signs on the weekly chart, the very chart that spans over entire primary and secular cycles. Now, this episode is based on upper bearish blue closings on the weekly, the early strong warning signs that the fun is over for many years to follow. These signs on their own may not mean it's all downhill from now, but the probability of that being the case neither can nor should be in any way ignored. And especially so as they are not isolated signs, but rather clusters circled at around the same time span. In this sense, this could be the sign that we have topped out and are ready to pay back what's unjustly taken due to artificially low interest rates. And especially so as they're not isolated signs, but rather clusters circled at around the same time span. The core message of this very episode is to highlight the high-risk danger zones at which the following stocks are at. For anyone who has long positions in any of these companies may do wisely in taking a moment to reassess the risk situation at hand by which you currently expose your portfolios. I have found legio of examples. What follows in this episode are some prime examples in popular and highly traded stocks. For if we were to present every single finding, then this episode would go on for hours. With that said, do note that nothing of what I say constitutes financial advice, not a single word. And if you appreciate this episode and what I'm about to present gives you a more holistic understanding of the risky situation and possible all-time high reversals at hand, then please return the favor by hitting the like and subscribe buttons. And more importantly, share this episode with others who may benefit from hearing this too. This, ladies and gentlemen, could very well be the final reversal for dangerous times ahead. And to those of you who haven't watched them yet, I strongly propose you take an hour to plow through the RSI trilogy. It might be the wisest decision you'll ever make for your savings, and equally so, this entire episode is based on the strategies and wisdom presented in those. Let's now get down to business. Let's start off with Nikola. This stock is an exception as its signal was given already in August last year. Since then, the price has dropped by no less than 80%. With that said, we are currently flirting with a possible lower bullish red closing for a relief rally. But to be frank, I expect no more than a temporary little run before proceeding down lower. Moving on to NIO. This may sound counterintuitive, but in the long term it is higher risk to buy now than it is to buy at $55. Don't underestimate the difficulty and danger in the RSI being able to recover past above the upper bearish blue. Sure, it may make a little rally of 10, 20 or even 30% from the current levels, but we don't know that. It can just as easily roll over right now, never to recover, just so that you can find yourself being a low single-digit number bag holder a couple of years down the road from now. For is that really a risk you'd be willing to take? And for your knowledge, this concept applies to each and every case we'll present in this episode. Now to Amazon. Here we need to look at the monthly chart. I normally don't use this for RSI purposes unless in exceptional long-running circumstances, and Amazon sure qualifies. Here we were warned both a few percent away from the IT peak in 2000 and before Amazon plunged by 95% and was ultimately hours away from bankruptcy, and we got a last-minute warning at the second peak prior to the 2008 debacle. Now we have a 16-month-long RSI divergence on this very same monthly chart, one that I expect to retest this 20-year-long primary trend line at which we'll see the RSI come down with it, and then our high risk to reward shorting spot will materialize once the RSI retests the upper bearish blue from below. And mind you, this will likely occur above the trend line for an as usual much early warning sign to take your money and run. If, however, such upper bearish blue signal were to materialize as the price retested trendline from below, then we're in for the low risk short of a century. Moving on to Evolution, a Swedish darling or a national treasure if you may. Evolution has given us no less than 3 consecutive warnings on the weekly chart, after which the price has lost 44% at most. And to add fire to the fuel, this all happened after the strongest build-up, during which the RSI had been swarming about above the upper bullish red line for 2.5 years, before finally succumbing and saying its adieus at the upper bearish blue line from below. Now, can Evolution still recover? Of course it can, but is it likely? No. From a risk-on point of view, the safest bet is to enter if or when Evolution were to take out a new all-time high and thus break the bearish spell of this upper bearish blue action right here. Personally, I'm looking for a short, and I have a strong low-risk, high-reward setup prepared already, one that I have shared in detail on AUGERE, link in the description below. ENAD Global 7 has been a buzz on the Swedish market for some time. Needless to say, we again got 2 major warnings, one in April and the other one in May this year. After those, the price has dropped by 90% at most. With that said, we are currently flirting with a possible lower bullish red on the weekly. The only problem is that we don't have any history and precedence, so we don't know where that line actually is. What we do know, however, is where the lower bullish red line is on the daily chart, and this, ladies and gentlemen, is something I'm still kicking myself for having missed out on. Last week we got a lower bullish red signal on the daily chart, after which the price took off by 80% in just 2 days. And to add salt to the wounds, we had a long bullish RSI divergence, one that I in fact had been keeping an eye on for quite some time. Yet I managed to miss out on this lower bullish red signal, which ended up costing me a lot of money in missed out profits. And this is the only major downside to these strategies, the fact that they all need to be catered to individually and manually. And just like we have a prospect lower bullish red buy signal in ENAD Global 7, the same principle applies in AUGERE Bio. Now in AUGERE I don't know, I still have no freaking clue how to pronounce this. Just gonna call it a stock from now on to make things simple. The same applies to this stock, at which we got a sell signal at 325 kronor on September 10, after which the price had gone down by 94% by November 26th. And if we go back to the weekly chart, just like in ENAD Global 7, we are currently flirting with the lower bullish red line from above. The only problem in this case is that we have no idea where the correct lower bullish red line is, as we have no historical data to confirm such line. And this leaves the downside price margins rather huge, as the weekly RSI can easily go down to the 37 area. So if you enter this stock based on this highly blurry line, then do for heaven's sake adjust the risk accordingly and keep your bet size small. Just because we were to get a lower bullish red buy signal, even if that line were to be correctly set, it doesn't automatically mean it will turn into a winner. It can just as easily get stopped out. For our margins when it comes to the RSI strategies lie in the winners being extreme and the losers marginal. This is why we often get risk to rewards in the 50 to 100 to 1. Moving on to another Swede, in this case Fingerprint Cards, we got a sell or short signal already back in June. Since then the price has dropped by 45%, and the previous time we got an upper bearish blue sell or short signal was at the very end of this distribution channel near the all-time high, after which the price proceeded to lose 95% of its value. And again, to prove how severe a 95% drop really is, if you were to have bought in at this seemingly accumulational level, which in turn was 85% down from the signal, then by the time Fingerprint Cards was down to its 95% loss, you would have lost 65% of your investment already. And that's the difference between an 85 and a 95% drop. The difference is not the mathematical optical dilution of 10%, it's in fact 65. So by no means is this negligible, it's massive. And this in turn is why it's so incredibly difficult to buy during a bear market. For even if you were to buy at the second lowest plateau, you can still find yourself being stuck with intimidatingly huge losses before the ship turns around and begins to move up. And finally, two media darlings, Gamestop and AMC. Now, Gamestop recently established a symmetrical triangle distribution, and 1 month ago to the day we finally got an upper bearish blue closing, after which the price has dropped by 42% at most. The previous time we got such signal, the price bled by 95% at most. The same goes for AMC, symmetrical triangle, breakout, this case 2 upper bearish blue signals, after which the price has lost 50% at most. The last signal in AMC was given in April 2019, after which the stock lost 90% in less than a year to follow. Again, ladies and gentlemen, these are just a few out of many examples I've found over the last couple of weeks. But given the magnitude of how many signals we are seeing at the moment, and with that said, do bear in mind that not all stocks and equities give us upper bearish blue warnings. This to me speaks volumes that we may in fact have topped out from this 12-year-long bull run. If that were to be the case, then put on your crash helmet, because we're gonna be in for a long, severe winter, one that may last for 10 to 20 years at least.